Thanks, boss. QuantCon is my favorite quant trading conference, but I have a problem of keeping up because every year the level of the sophistication of the talks get higher, and I feel that I need to keep doing deeper and deeper research just to keep up with the crowd. And this is one of those complicated talks that we have prepared and going to talk about today. Actually, it's some work that we have done in collaboration with our quantitative researcher in the firm, Dr. Ray Ng. And it's about optimizing trading strategies using a method that is quite complicated, which most people would not have used ordinarily. So let's take a look at our typical backtest workflow. We have some price series, historical price series, and we have a trading model that might be defined by a number of parameters, which we use to apply to where we can have these prices feed into this model and generate buy and sell trading signals, for every bar. And from this trading signal, obviously, created long and short positions. Again, you can imagine, each bar defines whether you should be long or short a particular asset. And then these positions generate P&Ls based on the real market prices. Okay, so that's a typical method how we can backtest a trading strategy. And by optimizing trading strategy, what we usually mean is that, for example, we might optimize the sum of the P&L by tweaking the parameters in the trading strategy. All right. The problem with this approach is that typically the number of trading signals is far fewer than the number of prices available. Unless you are doing high-frequency trading, which has its own problem. But for the majority of trading strategies, you don't get to make a decision every bar and and put on a new position every bar. Because of this inequality, it is very easy to cherry-pick trading signals to optimize based on your historical time series. That's a well-known problem. People call it overfitting or data snooping bias and so forth. And this method of optimizing a trading strategy results in a trading model that has no predictive power on unseen or out-of-sample data, right? Because you are just cherry-picking your parameters that happen to be best for a small number of these trading signals in the past. So what are the ways to overcome this very common problem? One way, the most naive way, of course, is to, give it more data, right? So with longer historical backtest period, you get more trading signals. And with more trading signal, hopefully the number of trading signals relative to the number of parameters in your trading model is getting larger and larger, and so the statistical significance increases as well. But there are some problems with this approach, namely that sometimes the older historical prices are not very relevant to your trading signal for your trading strategy. For example, pair trading used to be very profitable prior to, let's say, 2002 or something. That reason for that is because in the old days, the bid-ask spread is much wider due to the fact that the minimum tick is 1/16 or 1/8 sometimes. After decimalization of the US stock prices, all of a sudden the bid-ask spread collapse. Typically nowadays is 1 cent or even less if you're trading on certain dark pools. So if you are using old equity data prior to, let's say, 2002 to backtest an equity model, you would actually get a tremendous return in the old days, but that's hardly relevant to the market microstructure today. So, regime changes, market microstructure changes, macroeconomic changes render some, older data quite irrelevant, actually, for optimization. It might actually create a quite suboptimal model going forward. And Now, last year in my talk, I discussed one method of overcoming that, and which is using a machine learning technique called bootstrapping. Some people would call it oversampling with replacement. Essentially, you sample your old data random number of times to generate more noise in the old data to prevent your trading model from fitting too well to one particular realization of the historical path. Now, that's certainly valid method to deal with it, but it is less easy to implement that for time series data. Because obviously time series data come with a embedded autocorrelation structure. You cannot just take one particular day's prices and replicate it 5 times and stick it randomly, sprinkle it throughout your historical data. You would destroy the autocorrelation structure. So that particular method was most suitable when your data has very little autocorrelation, and each data point can be treated as independent. So you can sample them repeatedly without trouble. So that's so much for that. So now, this year, we are confronted with a lot of training models where it does have to confront this autocorrelation, serial autocorrelation head-on. Okay. So there's another method of dealing with this overfitting problem, and that is to create a mathematical model of the historical price and find an analytical optimal trading signal. Now, if you can do that, you effectively have an infinite backtest period, right? Because it's a mathematical model. There's no data involved, actually. The drawback of this approach, besides that it is quite challenging, mathematically, is that the price model tend to be very simple. It's not. I will show you a couple of analytically solvable model later on, but it is not going to be very realistic in general. And when not only the price model has to be simple in order to be analytically tractable, but also the trading model has to be very simple. Right? Essentially, the trading model has to be linear to the prices. It cannot have all these bells and whistles that we all like to put into our trading strategy in order to make it work in real life, right? So linearity of trading signals. And then finally, even the performance objective that you are going to optimize has to be simple and linear. You cannot say, oh, I want to optimize the return subject to a maximum drawdown constraint and so forth. It has to be, the performance objective basically had to be as simple as, okay, what's the P&L per trade, right? Which is linear, linear related to your trading signals and to the underlying prices. So, but I will talk about a simple mathematical model that people have developed in solving that problem and use that as a contrast to what we can do with a simulation approach, which is the main thrust of today's talk. In a simulation approach, instead of creating a mathematical model of a historical price series, we simulate them using a discrete model, right? But by a discrete model, of course, is in some sense is still mathematical, but at least it's easy to program it in a computer and generate one price after another without limit, right? It's not as nice as a continuous model of the prices, but at least you can programmatically generate as many prices as possible. Okay, so the only constraint is computational resource rather than the availability of various mathematical techniques. And furthermore, because of this, a program can be as complicated as you like, as most of us know. We are all have some programming experience here, I think. And unlike mathematics, you can make a program as complicated as you like and as close to reality as you like. So you can capture many of the quirks of actual historical prices. For example, you can certainly capture serial correlation, you can capture volatility clustering, you can capture jumps and tail events, whatever you like, whatever you read about in papers, you can just throw it into your time series model in your computer. Okay. And then finally, with a simulation approach, there is no limit on what kind of trading model you can impose on this time series, on this simulated time series. It doesn't have to be linear anymore. You know, it can be as complicated as what most of us do when we actually trade live. It can be certainly a nonlinear trading strategy. And furthermore, the performance objective can also be nonlinearly related to this trading signal. Again, we can measure a karma ratio. We can measure Sharpe ratio. We can optimize anything subject to whatever constraint that we so please. No longer constrained by what is analytically tractable. Okay, so that's our goal in this talk. We want to get there. But before we get there, let's see what mathematicians have done so far with regard to the analytical optimization of a trading strategy. So the simplest price series that mathematician can handle and that is meaningful is a mean reverting price series. Of course, the simplest price series would be a geometric random walk, but we all know that you can hardly develop a trading strategy based on a geometric random walk. So the simplest price series that you can actually trade on and earn a consistent profit is that of a mean reverting log price series. And that is well known, that is described by continuous equation called the Austin-Uhlenbeck equation, right? So this is a equation where dx, x is a log price, let's imagine. It's always nicer to work in log price space than price space because then the noise is simply a Gaussian rather than some complicated log normal distribution. So dx is the change in the log price in the next time period. And the last term, I wonder if I can use a pointer. Actually, maybe not so easy. Let me just. Okay, well, it's hard to point, but anyway, the last term here is a simple random walk term, right? You have a dw, which is a Gaussian noise term, multiplied by volatility factor, sigma. We call that the conditional volatility for a reason that might become clear later. And then that part is just a simple random walk. And then you have the first term is what's important, is a mean reversion term. Theta is the mean level of the log price. And what this term says is that whenever your price is higher than theta, the mean price level, there is a force that brings you downward back to theta. And whenever the price is below the mean level, okay, if x is less than theta, there is a force that causes the next move to be upwards. It brings you back up to the mean price level. So that's a very intuitively understandable equation, except that it is written in a continuous price space. But because it is written in continuous price space, it's actually analytically solvable. There are, you can write down an analytical solution of what the log price is going to behave going forward. Okay, so but that's just the base price level. What the model for the price? What about a model for a trading strategy? Okay, so we first have to decide what kind of trading strategy we want to impose on this simple mean reverting price series. The simplest thing that one can think of is almost like a Bollinger Band method, right? We want to find out what is the optimal entry level, how far away from the mean the price has to be before we get into a long or short position, and how far away from the mean we should get out, we should exit due to a profit. Okay, so by optimal entry and exit levels, what is the objective? What are you trying to optimize? Well, as I said, you can't optimize anything too complicated with this kind of analytical model. So people have only found the simplest objective, which is just the round-trip profit. Okay, it's one round-trip profit. Can't do anything more than that if you want to be analytically solvable. So okay, we'll stick with that, but with a caveat that there is a certain time discount factor. So for example, if your trade lasted 1 year and you only make $1 at the end of that year, it's not as good as if your trade lasted 1 minute and you make $1 at the end of 1 minute. So there is a time discount factor that you do want to impose on this expected profit. But still, it is an extremely simplistic objective, and that's the only thing that people have been able to solve so far with this simple objective. So the solution of this, what is the optimal entry and exit level? In other words, think of it as the optimal Bollinger Band for mean recurrent time series. The solution to that is given in a book by 3 authors, Professor Carty and et al., published in 2015. It's called High Frequency Trading. So in that book, they have utilized some quite advanced mathematics from stochastic control theory, Hamilton-Jacobi-Bellman equation, and so forth, to transform this stochastic problem into a deterministic problem. Transform a stochastic differential equation into a partial differential equation. Right? That's a big step because a partial differential equation, though it's hard to solve, you can solve it numerically with any precision you like. So that, I'm certainly not going to display all the complicated math, but just to get to that step is a mess if you read that book. And still we are still stuck with a very simple model like that, even with all this advanced mathematics. But there's something very interesting if you look at the solution. For example, they find that the entry and exit level are asymmetric with respect to the mean if you have a non-zero time discount factor. I will show you graphically in the next slide all these interesting features of this analytical solution. Right? But let me just go through them in words first. The entry level, turned out that the optimal entry level is closer to the mean than the exit level. Okay. Both of them, however, both exit and entry levels, their distance to the mean increases with a decreasing kappa. Kappa measures the rate of mean reversion. So the weaker the mean reversion, the farther away from the mean you should enter or exit. That's eminently intuitive, right? Because if in the case of, in the limit of no mean reversion, you should never enter. You should wait forever before you should enter, right? So that's eminently reasonable. And on the other hand, if there's very high rate of mean reversion, you better enter into this asset very quick, very soon, right after it deviates a little bit from the mean, because very soon it will mean revert, right? If the rate of mean reversion is high, you need to be in a hurry to get in. Okay. And then also, the distance of the entry and the exit level to the distance of that to the mean also increases with increasing conditional volatility. That's also reasonable. If the series is very volatile, you might as well wait until it, by chance, get very far away from the mean before you enter. Right? So no reason to be in too much of a hurry if by random fluctuation it might hit a very large deviation. So these are, these features are all very intuitive, these features from the analytical solution. The last 2 points, in fact, can be combined because if you calculate the unconditional volatility of a Olsen-Uhlenbeck equation is just the conditional volatility divided by the square root of 2 kappa. So the 2 factors can be combined. And that's also apparent if you look at the analytical solution. But the last 3 points are a little bit interesting. They find, for example, that the long exit is the same point at the short entry. So in other words, and vice versa. That means at no point in this optimal solution are you flat. Right? When we trade mean reversion strategy based on Bollinger Band, oftentimes there's a sort of no-go zone, right, around the mean where we are neither long or short. That turns out not to be optimal based on an exact solution. The exact solution said that you should either be always long or short. There's no point where you should be flat. It's quite interesting. But also that whether you are long and short is not only a function of your current price. So you cannot know by looking at the current price level compared to mean whether you should be long or short. That long and short position is path dependent. So this stochastic differential equation solution is quite intricate, even with a simple model. It gives you a path-dependent solution for your position. So let's summarize all this by a simple picture from this analytical model. So you have a mean level here, denoted by this horizontal line, theta. The long entry level is denoted by this blue dot. It's very close to the mean. And once the price drops to or below this long entry level, we get into a long position, we buy, and then we will keep this long position even as the price goes up, right? Until the long exit level denoted by the green dot. And that long exit level, as I said, is going to be farther from the mean than the long entry level. And then once you get out of the long exit position, you will immediately enter into a short position. And you will be shorting and shorting until the price drops to the original long entry level, whereupon you switch to a long position. So at no point in this, at no price level are you flat, okay, as I said. And furthermore, the distance between the long exit and the mean and the long entry with the mean scale with the square root of the sigma squared divided by 2 kappa, as I said. So this is a summary of what we said. So it is, I think it's quite interesting. Bollinger Band trading, it's kind of the first thing I guess a quant trader learn about by reading, right? It's the easiest thing. But it turns out that you can create a mathematical model to it and find the exact solution of what constitutes the best Bollinger Band model, and this is it, according to these authors. Given, with the caveat that the objective that you're optimizing is not the average return, but the return of one single trade. Very big simplification. So it sounds nice, it's very elegant and exact, but there are so many problems, so many caveats and shortcomings in this model. What if, for example, the underlying price is not a simple mean reverting price series, as he said? What if there's volatility clustering that has to be modeled by a gauge model of whatnot? What if our objective function is not just the profit of a single trade? Maybe a simple thing like a total P&L. Already, this model cannot describe it. What if we're interested in the annualized return? We have eminently reasonable criteria. Everybody are interested in the annualized return. Well, that's not possible not easy at least, to analytically determine based on this model. So, the smallest changes to this model make the equation very difficult to transform the stochastic differential equation into a deterministic PDE. And that's why we need, for practical purposes, we need to use simulation, not mathematics. Even though it's so elegant and so exact, it's not really useful for most practical situations. Okay, so that brings us to the main thrust of the talk, which is that how do we use a numerical simulation to accomplish a lot of what a mathematician wanted to do but are unable to do. Okay. So let's say we stick with a simplest time series model for illustration. It could be as complicated as you want, as I said, but let's start with a simple one, such as an autoregressive model. In fact, we can start with an AR1 model, which means a model that tells you that the future price is linearly related to the current price and plus some noise term. Okay, I will show you the exact equation of that, but it's as simple as you can get. It's very similar to the Austin-Uhlenbeck equation, except that the prices at the time is now discrete rather than continuous. Now, and also, we want to use the objective of averaging, the objective we want to optimize is that of the Sharpe ratio, not rather than a single period return or a single trade P&L, right? That turns out to be not useful for most people. So we are interested in maximizing the Sharpe ratio. Now, but even saying that you want to maximize the Sharpe ratio, they can have two meanings. One is that, let's say we simulate many of these price series based on an AR1 model. Okay, we have, let's say, 10,000 replicas of this time series over however long, 3 years, 5 years, or whatnot. One way we can formulate our objective is that I want to maximize the average Sharpe ratio across all these 10,000 paths. That would be, in spirit, very similar to the analytical solution. Right? That analytical solution is also maximizing the average of something across all the paths. And we can do the same in simulation, no problem. But alternatively, you can also say that we want to find the trading parameters that most often maximizes the Sharpe ratio of a simulated price series in a manner very similar to a maximum likelihood estimation. In that second scenario, we are only looking at a bunch of paths, not averaging across all the paths, but only looking at those paths that has the highest Sharpe ratio. We will compare the pros and cons of the two approaches. But just to have a spoiler, the first approach is actually more accurate. OK, so just to illustrate the workflow of this simulation, we have, first of all, we have to start with historical price series, just like any other backtest. That's at the top box. And then the next step is that we will have to fit a discrete time series model to it. In our case, let's stick with the simplest autoregressive model, usually fit by a maximum likelihood estimation. No problem with that. Any financial time series textbook will have a function for doing that. Any software package will have a function for doing that. OK, so after you fit the AR model to the historical prices, now you say, well, here we are, aren't we overfitting? Because we still need to use one particular historical time series to fit this model. Yes, but we are not fitting a trading model. We are fitting a time series model. There are many prices, many more prices than trading signals, right? So it's OK to fit a time series model to historical prices. It's just not OK to fit a trading model to historical prices. There's a big distinction here. Okay. But let's assume that we can fit this prime series model very easily and without overfitting. We can then run this AR model and generate as many simulated price series as we like and for however long as we like. Let's say we generate 10,000 of this time series, and each one might be 10 years long. Okay. Then we can run our trading strategy, no matter how complicated, with a particular parameter set on each of these prime series and find out the Sharpe ratio. And as I said, one approach is then we can adjust the numerous parameters of this trading strategy so that the average Sharpe ratio across all these paths, 10,000, maybe 1 million paths if you have a big computer, so that you can maximize it. So that is no problem in the simulation because you are not subject to scarcity of data. You can generate as many copies as you like. It is almost as good as an analytical optimization because there's no limit to how many time series you can generate, and therefore as little overfitting as is possible. So now you found the optimal parameters of your trading strategy based on this simulated time series. You can use that trading strategy, which are now completely specified. All the parameters are specified, and then do a real backtest on either the original price series or on some out-of-sample data to see how well your fitted model really does, either in sample or out of sample. So that is the workflow of a simulation approach to optimizing trading strategies. So let's do a quick and simple example. Let's say we want to optimize a Bollinger, a mean reverting strategy, not mean reverting strategy. It's optimize a simple trading strategy on a Forex time series, AUDCAD. It turns out that I picked this time series because it is quite mean reverting on a hourly time bar basis. If you run an ADF test, testing for stationarity, it is better than 1%, the p-value. So it's a highly stationary time series. If it isn't, we will have a problem, because if it isn't, it's most likely going to be very close to a random walk, and no matter how good a trading model you throw at it, it might not make any sense, right? You have to have something that is not undergoing random walk in order to have any sensible trading strategy. So this is a good candidate because of its stationarity. But instead of applying a OU model, a continuous time model, we are applying a discrete model, AR1, autoregressive with lag 1. Very simple. The future price or the future log price is linearly related to the current stock price plus random noise. And in fact, that random noise is given by Gaussian. And I have, there's no implication that this simple model is a good model for AUDCAD, right? It's just a first step. Most likely you will find that it is not a good model. How will you be able to find out that it's not a good model? Well, if you try a more complicated model, chances are you will find a higher expected Sharpe ratio in a simulation. It's easy to tell. So there's no constraint on how complicated a model you can impose on this simulation approach. But of course, we should start with the simplest, which is what we're doing now. So this model has only 3 parameters for the time series model, not for the trading model. Time series model has only 3 parameters, which you can easily fit with any standard software. Okay. Now that you have computed the parameters for this time series model, you can generate as many pi series you like, 10,000 if you like. Each one might be 3.7. That's what we did. We generated 3.7 years long pi series. And the reason we picked that is that it is about 10 times the half-life of mean reversion. Right? You cannot generate a time series that is shorter than half-life, because the trading strategy can hardly have time to make any money, and already you say, okay, game is over, let's liquidate, right? That doesn't make any sense. What kind of trading strategy is that? So you need to let it at least have some chance to generate profit. So let's just ballpark figure, let's make it 10 times the half-life, which turns out to be about 3.7 years. So for each time series, we will backtest a very simple, what is a simple strategy? Well, simply buy if the expected log return is greater than some multiple times the times the conditional volatility, and sell if it is expected log return is less than the negative multiple of that same conditional volatility. Otherwise, neither buy nor sell, just leave it flat. So this is even simpler than the sort of the Bollinger Band model, right? This is each period we get to make a decision. We don't care about the history. There's no history involved. It's not path dependent. At each point, you look at that most recent period return, and you decide whether whether it's a large number, positive number, or very negative number. Otherwise, you do nothing. Extremely simple. Now, again, this is just for illustration. Nobody said that this strategy is the best. For this approach, again, you can impose as complicated a strategy as you like, right? But this simple strategy has only 1 parameter. You can have a strategy that has 10 parameters, which in this case doesn't have the data snooping problem, because you have infinite amount of data to fit your 10 parameters, unlike the traditional approach of backtest. If you have a 10 parameter trading model and you apply to a backtest time series, most likely you're going to overfit it. But here, we don't have that problem, because you can have 1 million of this price series. Okay. So, and we can, of course, also impose a transaction cost to our trading strategy. So no worries. So as I said, there are 2 ways to find the optimal parameters. One is to maximize the average Sharpe ratio across all these 10,000 paths. And if you take that approach, which is mathematically summarized here, you find the Sharpe ratio 1 path given a particular parameter k, and then you take the average of this Sharpe across all different paths, and then you find the argmax of this expected Sharpe ratio over all the parameter k. Okay, so that's a mathematical summary of what we are trying to do in our computer, and it turns out that the optimal parameter is 0.0088. with some error bar. How do I compute the error bar? Well, we compute it by giving the simulation different random seeds and see how different the optimal K comes out, right? So you do get some sense of how much randomness there is in this optimal, and it turns out that we can estimate it to be second decimal place. And as I said, there's another way to do this, which is instead of looking at the average Sharpe ratio across all paths, we look at the Sharpe ratio of a path with a given parameter, and we find out what are the maximum Sharpe ratio that we can get by tuning the parameter. Okay, so for that particular path, maybe a certain K give you the best Sharpe ratio. And then you can plot a histogram of all these paths and see what particular parameter give you the most paths with the highest Sharpe ratio. Here is a picture of that. So you can plot for each optimal K, you count how many of the paths has the highest Sharpe ratio, and then you just pick the mode of this distribution to locate the K that gives you most often give you the K that gives you the best Sharpe ratio for most realization. Okay, so that's the second method, and with that you get a slightly different K, 0.01 instead of 0.0088. But you notice also that the error bar is much larger, because in this case, you are determining the optimal K using a small subset of the path, those that give you the highest Sharpe ratio, instead of averaging across all the paths. So the second method is a little bit less precise, but it may have a better intuitive meaning, because you can see the distribution of Sharpe ratio as a function of the optimal K, and you can see that, oh, for that K, most paths, you are most likely, in some sense, to get a highest Sharpe ratio, right? Okay, but anyway, you get not too different result within error bar with either of the method. So now is the time to see how well it does in an out-of-sample test, and here it is. It doesn't seem too impressive, right? The Sharpe ratio of this path, of this trading strategy with a given K, give you this cumulative return out of sample. Out of sample means that we didn't use any of this data to fit the time series model, and certainly not the trading model. Right? So yes, it's positive. Yes, it's a positive Sharpe ratio, but it's hardly something that everybody is going to start investing millions in. Now, why is that? We'll see why that is the case. Why is the result not that impressive? Let's do something to test out our optimal solution. Let's just randomly pick some other parameter, K equals 0, let's say. Instead of K equals 0.008, let's try what is the backtest, out-of-sample backtest look like with a supposedly suboptimal parameter K equals 0. And it turns out that it has a better Sharpe ratio. The cumulative return looks better with just this, not randomly picked parameter. And you say, well, how can that be? We did so much work generating thousands and tens of thousands of this time series, do this and that, with all this sophistication, and you ended up with a trading model that doesn't look as good as just randomly picking a parameter. What's going on? Well, there are many things that is going on, actually. Why is a so-called suboptimal parameter can give you better out-of-sample result than optimal parameters? Well, one reason, possibly, is that the time series model we have fit using a fixed in-sample set. Certainly, if you are doing real live trading, you would refit this AR1 model continuously with new data, either with a moving window or with an ever-expanding window, right? So nobody says that the time series model that you fit using data prior to, let's say, 2003 is still going to work today. So you might as well continuously refit your time series model. That's one reason. But more fundamentally, this methodology does not promise that a particular realized path, that our optimal K will be optimal for a particular realized path. That is the crucial thing that we can actually get out of this. In other words, what we have optimized is the average Sharpe ratio over 10,000 paths. But if you just pick one of them randomly, clearly, we know from this chart that it could well be suboptimal, right? Because, for example, if you pick a k at 0.05 at the far right, there are still some paths where that parameter gives you the maximum Sharpe ratio. Or if you pick k equals 0 at the far left, again, maybe 450 of those paths have the maximum Sharpe ratio with k equals 0. So you have a broad spectrum of possible outcomes. And your actual out-of-sample path is one of them. It's almost like throwing a dart in this distribution. Where the dart will end up in this area under the curve is represent a particular realized path. And for that particular path, the optimal k doesn't have to be equal to the one that we found. We have done the best we can. We cannot force the future path to be one or the other, right? So that is one of the major problems in quantitative trading. So you have reached the limit of the possibility of probabilistic modeling because there is randomness in any kind of path going forward. You have no control over what it is going to be. And therefore, your optimal that you painstakingly find in the past may not be the optimal for that particular realization going forward. And that's a very important point to realize in any kind of trading. But is there only despair, therefore, in optimizing quantitative trading strategy? No, because this problem is very bad only if you are trading just one-time series, right? So with one-time series, of course, you can have a bad luck and the particular realized path fall way out of the typical path or the average path. But of course, if you are applying this model to 1,000 stocks or 30 different Forex series or 50 different Forex series, then of course with the law of averages, it is unlikely that all of them, it will be less likely at least, that all of them will be so far away from the optimal that this approach will finally work. So you have to, again, take an ensemble approach to make this, to realize the power of this method. Just using it to trade one time series, one instrument is not going to realize the benefit of it immediately. Okay? So I should mention that all this work actually we have done, and then after reading it, the literature, we find that actually Dr. Peter Carr and Marcos Lopez de Prado, which is our keynote speaker today, actually has published a very similar paper in 2014. But we swear that we haven't read that paper before we did this work. Well, our objective is not to get tenure in a well-known university. We are trying to make a few dollars for our fund. So it doesn't matter that someone else have actually discovered this methodology before. It's actually gratifying that this approach has actually been validated by other very prominent researchers. So what can we do to further this this methodology? One is that first certainly you can try different nonlinear function of price. You can optimize karma ratio or your conditional value at risk and so forth. You can extend it to any complicated time series model, adding any features that you think are important to your model. Gauge is the first thing. Actually, we try adding gauge to the model, and once you add gauge, the optimal K becomes 0, which is the one that gives you a very good, better Sharpe ratio. So apparently gauge is important. So by neglecting gauge, we find a solution, an optimal that isn't really suitable for this particular time series, right? And of course, if you can you want to get really fancy, you can run a recurrent neural network and whatnot that generate this simulation. You don't have to limit yourself anymore to a linear time series model. It can be as non-linear as you like. And certainly your trading strategy doesn't have to be as simple as what I described. Whenever someone tells you to buy, expected return is positive, buy, and expected return is negative, sell. You can be as complicated as you like if you want to extend it. So the conclusion of all this is that what we did before is that we try to optimize trading strategy parameters on historical data, and that approach invites severe overfitting. However, fitting a time series model to price data, but not fitting a trading strategy to price data is much easier. It's much better. It invites much less overfitting. And with this fitted time series model, you can use it to simulate arbitrary number of time series where you can now run your optimization without fear of overfitting and to whatever precision you like, with the only constraint being your computational resource. So thank you for your time, and hopefully see you next year. I'm happy to answer a few questions if there are. Sure. Okay. Well, just to paraphrase your question, I think your question is, how do we pick the best time series model in the first place? Because that that also have a almost infinite universe of time series model you can pick and infinite number of parameters you can fit. Yes, that is a problem, but there are established statistical procedure for fitting time series model and see how well it fit, right? And that is less of a problem than fitting a trading strategy because you have many more data, much more data to deal with than trading signals because of that inequality I talked about in the beginning.